So this top one here is the bull bear butterfly indicator, and this one comes out of years of trading and not being clear about which way to trade it. And it should, as we all know, should make sense. It should be pretty obvious which way to trade, but quite often it's not. So I wrote the software to tell me which way to go. All right, so below the red line, you're looking for shorts. Above the green line, you're looking for longs. Anywhere between the red and the green, you're looking for uncertainty. So it's flipping, flapping butterfly. So you can make your decision in that zone. So if you want to trade when it's butterfly, you can, but then you just trade according to the other indicators that I've written, okay? So below that, we've got this one here, which is the litmus test indicator. And this one is like the bull bear butterfly, but it operates on a faster time schedule. So it's also got a dotted line there and a dotted line there. When it's in between those, it's butterfly. And when it's above or below, it tells you which way to be trading. So for example, there, that blue line dropped out the other side of those dotted lines, and it says from here on, you're looking to short. Okay? When it's between them, it's saying, I'm not sure really, this could be going either way. When it's above, you're looking to go long. Yeah, so that's basically it. And so I needed something to say, pay attention, John, be disciplined, you know, this is what you're going to do.
Yeah.
And just stay disciplined. And that's big thing, stay disciplined.
The thing, isn't it?
Absolutely disciplined. If you trade against what the indicators are saying, fine, but you know, why?
The worst thing is if you trade against the indicators and you make a win.
I know, because then it makes it, I know, right. But, and of course it can go against it. I mean, it's the fact of life in trading. You never know the future, or you know the probabilities.
Anyway,
Sorry?
Indicators are always lagging indicators, aren't they?
Yeah, these ones are really, some of them are really, really fast, as you'll see. They get in there really, really well.
So how long were your trades open for then?
So, well, it varies, all right? I'll explain that a bit more in a minute. But my alert system sets up a target T1 and T2. Now, it might go beyond T2, so it might go a lot further than that. But as you'll see, quite often, a lot of the time, the trade only moves a bit and then it comes back and so on. Sometimes it runs a long way, like that. It comes on down a long way. But quite a lot of the time, it doesn't go very far before it turns around.
Yeah.
So, since quite a lot of the time, probably, I don't know, 70–80% of the time, it doesn't go very far before it turns back on itself, then most traders are going to lose money if they don't bank it.
Yeah. So you need to be.
So you need to go for T1.
What's the candles? What time period?
These ones here are currently 30-minute,
right? And
this works for anything. Doesn't matter what time period it is.
So you trade to give an indication. Yeah.
So you can trade weeklies or whatever you want with this. Okay.
Yeah.
But just for the point of for illustrating this particular chart, we're looking at the 30-minute. And so here we've got the next one, which is the M-Trader 3, I called it. And this one is, it tells you which way to go, but it tells you when to get in at a slightly slower reaction time. So there it says get in short there. All right, you can see where it kicks down.
But the butterfly...
So it says short.
Sorry, John, the
yeah.
Butterfly is still above the dotted line.
It's just above the dotted line in the butterfly zone. But the litmus test has gone short, but not quite outside, so it's still butterfly. The litmus is a butterfly short. The M-Trader 3 is a short. And at this point, just there, it says short if you go down below there, which indeed it did. And in this particular case, made you, whatever, 81 pips, I think. Or more probably, I don't know. So if you'd been trading off the basis of that one, then you'd be making money. Now, it doesn't work all the time, because sometimes things change around. Here, for example, it just moved a tiny bit in your direction before it came back on itself, which comes back to what I was saying just now about how often it is that it doesn't go all the way. So you need to have a strategy. You'll be banking profits on the way.
Yeah.
Yeah, which is why you've got the T1, target 1, and why you've got target 2. and you do multiple tranches. What I recommend is you do multiple tranches. So if you're trading, say, 3 units, you know, £3 a point, or 3 lots, or 3 minis, or whatever it is you're trading, what you do is you take a T1, you take one of them off the table, you immediately bank that. Irrespective of whatever else is going on, you take off one tranche at T1. What that means is you put some profit in the bank. So if it comes back on you, you've got a tiny bit of profit in the bank, and that's that. And if it comes back on you and goes slightly into loss-making position on the remaining tranches, it doesn't matter, because you've banked profit on the first tranche and you've probably broken even, so you're still safe. All right, so basically you're targeting not losing money. And by doing that, taking that piece off at T1, you give yourself you give yourself that slack, as it were.
And you give up
T1 running all the way.
To have money so that your pot is protected.
So you're aiming to protect your pot, reduce the risk of loss, and that's what your goal is primarily. But at T1, if you put a trade on and took all of your money and took all of it off at T1, you'd make 0.75% of your capital as a profit.
Yeah. That's not your pot, that's the capital that's employed in that trade.
No, the whole pot.
The whole pot, right, okay.
So if you do this system, you make 0.75% on one trade if you took everything off at T1.
Which is good.
All right, so that's one trade. If you made one trade a day, and you just got one trade a day correct, that's all, and you took it all off at T1, you'd make 0.75% a day.
Even if the previous trade had been losses.
All right. No. Then if you've got a previous trade which is a loss, you'd lose up to 1% on that. All right. So you've got to get more trades working for you than not. And I showed this to Jonathan, and he was basically, you know, over the moon with it and all that. And he's sort of looking at it on the 23rd of December. I did 22 trades during the day, which sounds a lot. And in those 22 trades, 20 were winners and 2 were losers. And it made over 6.7% profit on the day, just by sitting there and being 100% focused.
It's about 12 years if you put it in the bank.
You know, this pensioner's bond, right, is going to give you 4% in a year if you lock it up for 3 years.
Yeah.
And that was 6.7% in the day. You just work for one day, and that's it, done. You know, so I'm over the moon with it. I'm over the moon with it.
Pot high You're going to risk all of your pension pot. So, like you say, you still might have 90% of your money sitting there not doing anything for you, but the 10% you're going to trade.
Take a piece as a trading piece, and that's right.
Yeah.
So anyway, so that's the M Trader 3.
What time scale are we looking at there?
30 minutes.
That's a 30-minute.
This is a 30-minute candle.
Yeah.
So, and each asset that you look at, you'll have seen probably some of the videos I've put out about how you choose an asset, and what inherent risk reward you've got on a particular asset, and therefore which ones you should look at trading. Okay, so the software now tells you all of that in the alerts, as well as, you know, you can do it all on the spreadsheet and stuff, but this does it for you.
Be interesting to see on a given stock then, so if you've got that over the Quindale stuff, what that would give you in terms of those metrics. So these are this is where your IP is, isn't it, John? In those 4 or 5 graphs which you've got along the bottom there. That's kind of where that's the net sum of your wisdom, isn't it? This is everything codified. So here, for example, this one cuts down there. Look, the yellow one coming down. Yeah.
I call it my gold dust line, really, that one, because that is so good most of the time. It's just amazing. So here we are cutting down like that, and the gold dust line cuts down there, and it says go short there. Yeah.
Yeah.
And you see there, it comes up like that, and when it analyzes all the stuff that's going on, it says we're going short. So you put in a short at that level, and boom.
Why does it tell you when to get out?
When this kicks back up again, so the first thing is the T1, T2.
Yeah.
All right, so you take money off at T1, T2,
What's
whatever.
T1 and T2, sorry.
Target one, and target two.
So you're splitting your trade into 3 bits.
Yeah.
T1 is a third, I presume.
You can choose how you do it, but yeah, I would say for the most part, experiment with T1 at 1/3, T2 another third, and then let the rest run, which is 1/3 running.
So if you've got a trade on that's £3, you've got one T1, you take £1 off.
Yeah.
T2, you take another £1 off. And then T3, you've got £1 left, which you let run.
That's right. And when you hit T1, you move your stops to break even. All right. So the first thing that happens is you set that up, and then it moves to T1. When it banks T1, that tranche, you then move all your stops on the remaining 2 tranches to break even.
Yeah.
Right. So if it comes straight back, well, tough. You just banked 1 tranche. That's it.
Yeah.
And if it carries on running, then it'll hit T2. All right, and when it hits T2, you take that off the table, and then various strategies. You can just leave it running and manage it manually, or you can run a trailing stop behind it. The trailing stop that you run would be the TR value that I've got down here as well, which is also in the code.
So the more of these indicators that give you if they all go up to 1, that's telling you one thing, and if they all go down to 0, that's telling you another thing, isn't it?
Absolutely.
And the more
and
of them that you concur with each other,
the more you get in agreement, the better.
Yeah.
So look, all the way through there, you've got coming down. So this one here, which is in the butterfly zone, the bull bear butterfly is in the butterfly zone. That means we don't know which way we're going, we're a butterfly. So if we get a short in the butterfly zone, we might choose to take that. And if we get a long in the butterfly zone, we might choose to take that.
Yeah.
All right. And if you're in the bull zone on that, you don't take a short when you're in the bull zone, because it's saying we're bull, so don't do it.
But you've already gone short.
Well, we've gone short there, but see that bull bear butterfly is in the butterfly zone. Litmus is not yet ticked over, but this one here has gone down, saying we've got the potential for a short. So you might put on a trade to go short there, or you might wait until the next one kicks over. A litmus test has come down, so now litmus test is down below 0. M-Trader 3 is below, that's below, that's below. You get the alert there, okay, we take that one. So you can take that one, and so it comes on through. And here you see litmus test, then now it goes completely bare. But we should be in. We don't want to take off trade after it's moved all that way. What you want is a pullback. Here, M-Trader and S-Trader are both kicking in to show you the pullbacks. Now you get a short again there. So now we're short again there, and we get that one. And even though I say so myself, it's stunningly good. It's really good.
During real-time running then, because those candles will only scroll to the left every 30 minutes, so would those indicators be up and down during that 30 minutes?
The end of them, on the candle that you look at, the final candle, those indicators might be flipping up and down and doing whatever. Don't pay any attention to what they're doing.
Right.
What you want is you're only looking at the closed candle. But if you're looking at a trade and you want to get in slightly ahead, and if you're looking at it live, if it's in the last minute or so of that candle, you could go, okay, it's going to close there, so now I know what I'm going to do and do it. But the alerts operate on a closed candle, these things. So you take this, let's now make this bigger again. So I've explained the chart, and I've explained all of that. Now these are all the different alerts. There's so many trades, depending on how you set your system up, that it's like there's always another trade coming along.
Yeah.
So you can be in and out, go shopping, do whatever you want, come in, sit down and go, right, I'm going to sit and concentrate again now for a while. All right? And look, there's just trade after trade after trade after trade after trade.
What is that, just one day?
That's the alerts.
So these are all the alerts. So now, in answer to your question, Phil, that's 2100 at the end of the day, Friday. So you don't really want to be trading at the end of the day, so you're not looking seriously at any trades at that time. But if we come back through time,
Why is that?
The markets
because the markets are closed. So here we are, trades from, you know, in the morning all the way through there. And 7:59 is because of the clock time and the trading platform time and the clock time on my computer and stuff like that. That's a couple of seconds out. But actually what that was 8 o'clock. Okay, that was the close of the 7:30 candle or whatever it was. And different things you want to trade on different timescales, or you want the opportunity to trade on different timescales. So the DAX, you could trade on a 15-minute candle. But the gold there, XAU USD, gold dollar, you don't want to trade less than a 60-minute candle. And the reason you don't want to do that is because the inherent risk-reward ratios. Now, a lot of folks would tell you on all these different trading platforms and stuff like that, you're going for the 5-minute candle or whatever it is. That's all rubbish. That's how to lose money, is to trade stuff that doesn't have a proper inherent risk-reward. You know, and so this lot here gives you a flag. So let me take you through one of these at random. We'll just take the one I'm on.
These alerts have been set up based on those 5 indicators that you put in there.
That's right.
So if you change the, have you got like a user selection option which you can pick which algorithms that you want, or at the moment
Yeah.
it's fixed?
Yeah, no, you can do all of that too.
Okay.
You can choose which ones you're interested in. So if you're only interested in M-Trader alerts, you could set it up to only give you M-Trader alerts.
Yeah.
And if you want all of them, this one at the moment is showing you M-Trader, S-Trader, and M-Trader 3 alerts.
Right.
All right, so you can choose, and if they all kick at the same time, sorry,
Explain what indicator is trader.
they're just names for the indicators. For each one of those indicators, if I come back,
Yeah, I got you.
yeah, I'll just show you here. So, for example, come down there, that's the bull bear butterfly. The next one's the litmus test. And generally don't go against the litmus test, all right, as a general thing. M-Trader 3, M-Trader, and S-Trader. And I've coloured them green, amber, gold, and red. All right, so when you've got them all in a line, you've got to fully go one way or the other, whichever way it is. And the red one, the S-Trader, is the fastest acting one. That's the one that can get you in and out much earlier. But obviously, because it's faster acting, it's got slightly more risk involved in it.
Yeah, if you compare it with the yellow one, there's more noise on it.
But that's right.
Yeah.
Whereas the yellow one, the gold one line there, you know, that's got less noise, as you say, in there. So it's got a little bit more confidence level in it. Now, obviously, with the markets, the markets are going to do whatever they're going to do. So you never know what's really going to happen. But all you can do is say, this is where the probabilities lie.
Yeah.
And the bottom one, the S-Trader, is a very fine acting thing which tells you when the bulls and bears have their struggle, tells you which way it's moving. All right, so in a way you don't want to be trading against the S-Trader because that's telling you where the power is between the bulls and the bears. But sometimes you do, you know, sometimes you hold with it, depending on your trading strategy, whether you're deciding to go for a longer term thing or whether you're going for a finer grained action.
Question.
Yeah,
On, can I just
yeah,
show you with the mouse? Whoops.
yeah. Let me just put it on the crosshairs. Do you want to sit in this chair?
Yeah. Alright.
There you go.
Put my other glasses on.
Trading glasses. Trading glasses.
Yeah. Here, say, for instance, everything's in alignment, right?
It is, yeah.
If we're going bullish, right? The butterfly thing is still bearish, and it fluctuates a bit along here.
Yeah.
What makes here, for instance, a better trade than the one back there?
Yeah.
Even though the butterfly
To a
thing,
large extent, you can't tell And that's the nature of the market. You can't tell what's going to happen really. So sometimes it's hard to know. What I would say about that though is that's the pound dollar, okay?
Yeah.
And what you're looking at here is what time of day it is. Let's move this thing out of the way a bit so you see. There. All right. So here that's 6 o'clock in the evening, and there we are through there. Mm-hmm. So that's the close of the American market. So whatever's happening, people aren't interested in trading dollars or pounds after that.
Right.
Yeah. So in principle, they're not interested. So anything after there, you're probably not going to be bothered trading.
That's answered that.
Because people ain't doing that, right? So that's why it's going along sideways because nobody's doing anything. So irrespective of the fact of getting all these alerts.
It's open, but it's really closed because there's nobody there to generate movement with
the
them.
Americans have all gone home, they're having supper with their families and stuff like that. They're not interested. And the people in Britain are going like it's 10:30 at night, I'm going to bed. You know?
That's why I start trading.
What's the point? So that's what's going on there. And then if you come through here, look, the first move is 6:30 in the morning. So 6:30 in the morning, Britain's waking up. Some of the early traders are getting in there for 6:30 to take the 7 o'clock moves. Germany is waking up at that sort of time as well. So some of the German traders that are interested in trading the pound and the dollar are in there doing their stuff. So that's the zone there. That zone really is a trading zone.
Yeah.
So you just trade like that. You go, okay, so that's what's likely to be happening. I will look for when things are likely to be happening.
This is where concentration's really got to be in. Right?
And so
you have to be really concentrated on it.
you have to.
Well,
Yeah,
isn't that the name of trading?
it is. It is. Yeah. Especially when you're trading the 30-minute, you know. Like if you're trading other timescales.
Everything in trading is the psychology, isn't it? Because as many systems as you have and as many indicators you have, you've still got to get over the fact that you have got to put that trade on. So, you know, you've got to read that indicator and you've got to get away from, I know this is saying go long, but I think it's going to go short.
Yeah.
And the problem you get is the biggest danger in trading is when you go against your system and you win.
Yes.
Because once you do that, you think, I am a god.
I'm a genius.
I am a god.
Which of course you are, Phil.
Which I know I'm not, mate. Because then you think, I don't care what that indicator says, I know where the market's going to go.
Yeah.
Everything's going short, I'm going to go long. I'm going to put my entire pot on the table. Oh, I seem to have lost. And that's the problem, isn't it?
It is, absolutely.
It's all
Absolutely.
it's so much,
Right.
so much is so important.
Yeah, that's absolutely right. So does that answer that question?
Yeah, that's perfect, that, John. Yeah.
So I'll come back to this, any one of these, all right? Like I said, it doesn't necessarily say it's definitely going to happen. All it says, here's a trade alert. Here's S trader on gold, okay? And it's a 60-minute candle, and it says sell 0.3154 lots. Okay, so that's 3.1 mini lots on that, and it says sell it if it breaks below 1256.922. It says the stop is 1259.1732. It says T1 is 1254.55. T2 is 1251.91. It says the spread is 0.45. It says the TR, that's the trading range, is 4. Inherent risk reward is 6. So you want an IR of over 4, whatever you do. So some of these won't be over 4, in which case I just go, right, I'm going to forget that. But you want a trading range that's
IR
inherent risk reward.
Yeah.
I want it over 4. I like it 6. 6 is good.
Yeah.
And then it says that the reward, if it hits target 2, would be 2.2 of the risk that you're putting on. So that's a good risk reward.
So you're saying the risk reward ratio is 6 to 1? 4 to 1?
No, the risk reward here is 2 to 1. But the inherent risk reward is over 6.
Right.
Now, why the inherent risk reward is important is because each asset has a different spread. And if you don't have, if the spread's not in your favour, there's a wide spread, okay, the amount it's got to move to get you in profit is quite a lot, if the spread's wider. And if it's quite a lot, then you go, well, what's the point in doing that trade? Because the inherent risk reward is poor. So what you want is an inherent risk reward, which is strong. Yeah? Because when you do, even if you got it a bit wrong, the inherent risk reward is good, which means even if you move even a slight bit in that direction, you're probably able to bank it at break even. But if the inherent risk reward is poor, it's got to move a long way before you get to break even. Right, so don't bother with the stuff which got a poor inherent risk.
A bigger number or a smaller number.
So you want a bigger number on inherent risk reward. And 6 is fine, okay? 10 is obviously better, and so on. And they fluctuate not only on the basis of what asset it is, but also what time of day and what's going on in the price action and all that sort of stuff. You can't calculate it quickly by hand. So it's important to have a system that does that for you, computer basically.
Do you need to have a level 2 fee?
No, no
Where
level
do you get
2.
your data from then?
No level 2. It's just an ordinary data that you'll get. It's the price action. That's all it is. The price. Everything comes
How
out.
do you pick that up then?
It's just like any platform. You've got the chart live. The price is coming through. You just grab that price, and you grab it. I'm grabbing it all the time. I'm grabbing every tick, every second, and it's going into the system, and the code's
With all
taking
the
it.
indices,
Yeah.
So I guess what this is doing is it's doing what you were doing manually anyway, but automating it.
That's right.
And so what it's doing is it's taking away the majority of the effort to identify the trade in the first place.
Because you can essentially sit now. I can just sit there, and every half hour, a quarter of an hour, it'll come up with a few alerts, and I can have a look at the chart and make a decision. Am I going to take that trade? I'm not automating it because you still want to make decisions about it.
Yeah, give it a human.
Yeah. You still want to go and look at it and go, yeah, I'm happy with that. I feel confident about that one. I'll take it. Or it may have come up with a trade alert, but there's this going on, and therefore I won't take it. It's coming close to a support. It's coming close to a resistance. It's whatever. It's the wrong time of day.
Yeah.
And so you have your setup at the moment just with the 5 indicators, and that's why you've gone to market with it, with a platform that's simple stuff to start with.
Yeah, and you can see the top-down nature of it all, here. So each one of these, right there, it says that at that time we had a sell signal on gold on the S trader, and we had one sell signal on gold on the M trader. Yeah.
So are you able to sort of pick the Quindell stock up then and just drop that over?
Well, sadly, I can't because the reason is there are some platforms that will allow you to use. This is MetaTrader 4 platform, trading platform, and you can use it for all sorts of things. And different brokers will offer that on different things. Some of them will offer it trading through CFDs only. Some of them will offer it hooked into spread betting, which is useful for UK people. Some of them will offer it with stocks on it, and some of them won't. A lot of them just offer Forex on it, Forex and commodities and indices. If you look at the inherent risk reward on indices, the two strongest that you really should trade if you're going to trade indices are the DAX and the Dow. And those are really good things to be considering to trade. Which is why up here you can see I've got an indicator there, an alert on the DAX
So
on the 15 minute, because it's actually still got a good inherent risk reward. Look, it's got a 10, even at the 15 minute.
So your platform doesn't provide share feeds, then it only provides.
No, that's not
mainly-
true. No, it's not true. I was saying that a lot of people don't provide it on their platforms. There's a company called, no, I won't mention the name on the video, but anyway, there are companies that will actually provide feeds for shares. And essentially they're expecting you to trade CFDs in shares. And they will cover a bundle on the American market, a bundle on the UK market, a bundle on the German market, loads of different share assets. Now you asked about QPP, which is obviously close to your heart. None of them are feeding QPP because it's such a small company.
Yeah.
So they're only feeding maybe the top 100 of American companies.
Yeah.
Maybe top 30 or 40 of the UK companies, or
It's just not the trades a lot, I guess, where there's a lot of activity.
so they're looking at, that's right, where the volume is much higher and so on. QPP I can show you on a different platform, but I can't provide that to people to, like I can't offer that to the outside world because I'm offering it through MT4 at the moment. Yeah.
And MetaTrader is a universally accepted platform.
It's used by people all over the world.
Yeah.
MT4 as well. People in India and Singapore and Hong Kong and all over the world. People use MT4.
Yeah.
So within your platform, then you can place trades, or have you got to have a supplemental platform outside this for you guys to spread bets?
Yeah. So what I do, and it could be fully automated, but I don't want to fully automate it because I want to make decisions, and I think traders should make a decision on their own behalf. Am I going to do this or not?
Yeah.
These are suggested, entry points and suggested stops and suggested T1, suggested T2. So again, as a trader, you can decide not to do that.
Yeah, there's no liability for your product if there's a human in the loop.
Yeah, that's right.
Yeah.
So if you've got the human in the loop, you can go, well, okay, that's what's suggested, but I will do whatever it is. Or say, that's what's suggested, I will do exactly that. And that's entirely up to you as a trader. And that's always got to be true, otherwise you're not trading really, you're not taking responsibility. So, and then what the alerts will be basically associated with any one of these you've got. So, for example, here I've said that I'm interested in the Aussie dollar on the 30-minute, the hour, the 4-hour, the daily, and the weekly, which means that this alert system, when you've got the software running, will give you alerts for all of those at these different timescales.
Right.
Yeah, so that's why there's lots of stuff going on, because I'm saying, well, the Aussie dollar is an interesting thing to potentially trade, the euro dollar is something, the pound dollar is something, the dollar Swissy, which we'll have a look at the chart on that awful horrendous event that happened with the Swissy. I haven't got the euro Swissy on here because the spread on the euro Swissy, the inherent risk reward on it wasn't so good on the platform that I was using, so I wasn't even interested in looking at it. So basically got everything on there that I potentially be interested in, and also the stuff on there that I think that other people that might be interested in this software product would be interested in. Different people will want different things, so it's kicking off with lots. But if you were trading it, just privately, you might say, I'm going to limit this down to about 4 or 5 assets.
Yeah.
So that I don't get all the noise from all the other stuff, so that I'm only trading, let's say I'm trading 4 or 5 assets, then I'm only getting the alerts on those. Then I don't have to worry so much about all the other stuff. And then the other thing I think you mentioned, let's take that and bring that up. On here, on the charts, we've got the indicators list here. So, for example, if you said, I don't want to know about S-Trader alerts, for example, you then click on the edit button there and change that flag from true to false and say OK. And now you won't get any S-Trader alerts on the Euro-Dollar 4-hour. So you can zone in on specifically what you want.
Yeah.
So if you say, well, I'm cool with only having the M-Trader alerts.
Mm.
Then that's the only thing I'm interested in is that. Now, for me, I like having them all because I'll look at it and I'll make my decision anyway, you know. But if you want less noise, then you can switch some of the noise off by doing that.
But you don't get the whole picture, I guess.
Well, that's
You know, you
what
just
I-
don't get the whole alerts.
Yeah.
You still, the chart will still have the whole picture, but you just won't get the alert coming to
Oh,
you.
gotcha.
So I'm going to change that back to true because I want true at the moment. But, so I'll just change it back to true. Okay, and that's all there is to it.
So what do you do about money management, John? Is that part of your
That's
practice?
yeah. The money management I've explained in the when I showed the spreadsheet. Some of you have seen the spreadsheet, and I've got a video about all of that and about the all the stuff about money management. Let me see if I can find it. Right, there we are. Okay, so on the money management side of things, what we've got is this. So let's say you've got a pot size of 10,000, and let's say that you win 50% of your trades and you lose 50% of the trades. So that's not much more than trying a dart in the dartboard. But you might as well start with that as a premise. That I'm going to make, you know, half of them are going to work, half of them are not going to work. That's a premise. If I risk 1%, that means I'm going to risk 100 units, dollars, euros, pounds, whatever it is, per trade is my risk amount. Now this is the maths of it all. This says that if you've got 10,000 in your pot, these are the probabilities that in 10 trades you're going to get a number of consecutive trades that go against you. The probability is that on that just half thing, you're going to get 3.3 trades go against you in a row.
Yep.
All right, so that means either 3 or 4. So let's say it's 4. So if you've got 4 trades go against you in a row, you're going to feel a bit sick because you're thinking, oh God, another one that hasn't worked out. But the maths are that you will get 4 trades go against you in a row, and that's just normal. So you shouldn't go, oh God, it's terrible.
Yeah.
You should go, oh God, that's normal.
Or you should say, good, I've got 3 of them at the way, only 1 more to go, and I start playing.
And then it's done. Exactly. So that's just the probabilities.
Yeah, yeah.
So if you take that as being the fact, that fact is that to get back to 10,000, you need to make 4.10% profit on your capital to get back. Now, logic is that that's doable. To make 4.10% is doable, all right?
Yeah.
And therefore that is okay. But and if go over here actually while I'm explaining this, the probable consecutive losses on 100 trades, and if you're a trader, you're going to do 100 trades, and therefore you're going to experience that. You're going to get 7 wrong in a row.
Yeah.
And if you get 7 wrong in a row, you've got to make 7.29% to get back.
Yeah.
And if you're a trader, you're going to get 1,000 trades. And you're going to get basically this number here wrong. Anyway, you're going to get that number there wrong. So it means you've got to get 10.57% back
To get back to your pot.
to get back to your pot size. So that's just the maths of the probability of 50%. So let's say you do what they tell you on some of these trading courses, or you know, some people will risk 5%, let's say, of their pot on a given trade. And if you do that, then it says these are the figures you need to get back. It means that after 4 trades failed in a row, you've got to get 22.77% back to get back to break even.
Yeah.
And most people throw in the towel when that happens. They go, life's too hard, I can't deal with this. I've lost 22% of my capital. I think I'll try a bit more. I've now got 43% down. Oh, I'll try a bit more. I've got 67% down. Yeah?
You need another 2 positions to get an 85% reduction in share value.
So you can see that these people that risk 5%, basically they're saying, I want to lose all my money.
That's interesting, isn't it? That
Yeah, that's what they're doing.
Yeah.
There's no question, that's what they're saying. The trouble is, most people don't know that. Most people do, I'm only risking 5%, what's the problem?
Yeah.
Yeah, 20 losing trades and lost all you've got.
Yeah? So obviously 5% is not a good number.
No.
Now, if you go on some of these trading courses that I remember Pete and I first met on a trading course that said what you should do is have 3% in there. All right? And what they're saying is, well, that's fine. You will lose, in the next 10 trades, you will lose 12.96% of your money as a newbie trader.
Yeah.
You know, and actually, if you carry on persisting with this, you'll lose 23.77%. And that's, at some point in your trading, that's going to happen. And that's not good either. So if you put in here, either 1% or 0.9 is good. I think 0.9 is a good number in there. You can see that even if you mess up, and even if you're not really good at making trades, and even anything, so long as you do the trade management properly, i.e. never trade more than what you said you're going to trade, always put the stop on at the right place, always take the loss when it hits that point, whatever, then you'll never be down, after the first 10 trades, you'll be down 3.68%, which is highly manageable. You know, you carry on trading to, you know, to live another day and all that.
Yeah. Because you've still got your pot.
And you still got your pot. And even down here, look, that is, even at the worst case, you still, with after 1,000 trades, managing it like this and being absolutely disciplined, you know, you're going to be down at 9.46, which is fine. That's very doable. It could be argued that's not going to make you a lot of money, but trust me, you'll make a lot of money. I've been using this. This is what I was telling you about earlier. Using exactly this as my magic numbers, and trading with exactly these magic numbers, and taking the stops at exactly the right place, and taking the profits that we've discussed as well at the right place. That's how I made 3.6% on Wednesday, and 1.7% on Thursday, and 2% on Friday. Because the losses didn't affect me that much.
Make sense?
So it could go the other way as well, so that there will be a probability where after 10 trades you're up 10%.
Well, that's what you want. What you want is after 10 trades you're at 4%. You know, and if you've got, using my system here, it actually is shifting all the probabilities in your favour, and you probably will be fine with that. So that's asking I think, part of the question on that. And the inherent risk reward stuff comes from the market overview. And here's all the market overview. You know, so here basically I've got every asset that you might want to trade with regard to Forex, indices, or commodities. And this tells you whether on different charts, so like that says weekly, daily, 4 hour, 1 hour, and 30 minute, it tells you which direction you're going based on the bull bear butterfly indicator. So you know what you're looking at, what do you want to trade. So on this particular day, you were interested in trading the UK index short because it was red all the way through. Yeah?
Yeah.
So you go, okay, that's got to be a high probability zone. I'm interested in trading that short. So since I'm interested in trading that short, if I get trade alerts coming up, you know, on the code over here, if I'm getting trade alerts coming on there for the UK long, I just go, actually, I'm not interested. Yeah, because I'm only interested in shorts. But when I get a UK short coming up, I go, yeah, okay, I'm interested in that. So this is where the trader comes back into it. So then we come down through here and we can look at various things. But here, for example, you've got the Aussie dollar at that time. You're looking for shorts on the Aussie dollar. So any long on the Aussie dollar that comes up, you say, I'm going to ignore it.
Yeah.
I'll wait until I get a short alert on the Aussie dollar, then I'll have a look and decide. And over here, you're saying the New Zealand euro, I'm looking for longs. On the Aussie CAD, sorry, the US dollar CAD, I'm looking for longs. On the dollar yen, I'm looking for shorts over this period. So if I'm in the lower time zones, I'm interested in shorts. But if I'm weekly or daily, I'm in the butterfly zone, so I might ignore that completely. Yeah, because it's butterfly, so why bother? So there you are, you've got a roadmap for everything that you want to do. And then when you come back to here, you say, okay, that's what I'm interested in at the moment. And you can create templates which only has those things that you're interested in today. And you know which way you're looking at trading them, so you only trade the alerts that are going the right way for you. And if they're not going the right way, just ignore it.
Listen to there on the spreadsheet. When are you getting your values?
You have to put them in yourself.
At
Any given time.
any given time. Right?
Yeah. So you can put them in. You can put them in whenever you like.
Yeah.
So let's take this right now, for example. We're looking at the euro dollar here. Let's move this thing right out of the way so I can see what I'm doing. So on the euro dollar, I get the crosshairs on and I'm going across to there, but it actually tells you on the screen there what the value is. So the current value is minus 14.75 on the euro dollar 4 hour. So I come over here and I've got euro dollar 4 hour minus 14.75, so it's the same as it was when I last entered it. Okay, so as a trade alert comes up, you can either go through it all and do it up front, or you can just wait for a trade alert to come up on something and fill in the figures for you. So okay, so that's that euro dollar, there's a potential. Let's come up to that one. I've got different, I'm using bars and candles, sorry about that, candles there. That is showing minus 13.5, so back to my spreadsheet. Minus 13.5 happens to be the same. And go down to the 30-minute, and that is showing minus 10.75. So that is minus 10.75. All right, so you've done the lower time scales, and you can just go up to the higher time scales as well while we're at it. Daily, you can see the figure there is minus 14.75. Sometimes I find the bars easier to read than the candles, but they come to the same thing in the end. So that's minus 14.75 there, and where are we? Daily, minus 14.75, is that what I just looked at? That should be weekly, sorry. Let's make that weekly. And the weekly is minus 14.75, so there you are. So all of those are all correct, that's correct. So you're looking at euro dollar shorts. So now anytime you get a trade alert that says euro dollar short, you're interested in it. Anytime you get a trade alert euro dollar long, you're closing your shorts. And at the moment, nothing else. You're not aiming to go long on it, you're just aiming to close your shorts. So that's, you've got T1, T2, so you've taken the profits off at that level. The remaining tranche, if it's still in, you take it off when you get a trade alert the opposite direction.
So when you put your trade on, you automatically put a limit on it for T1,
Yeah.
T2.
Yeah, and you do that through here. So you put on a new order, and you put on whatever it says on the magic number down here. See if we can find one for euro dollar. There it is. It says on this particular case, all right, it says the trading range is that, the IR is that, so the IR is good. So in this particular case, euro dollar 4 hour 0.086, it says, is how much you're going to trade. So come back to this. 0.5 if you want a bit more than that. So how about 0.08? All right. And then you're going to do a pending order, and that one is a buy, which we're not going to do because remember euro dollar is short, so we wouldn't actually be doing this because it's going against the trade, and you don't want to do it. And you can see it, the bull bear butterfly is all wrong, so you wouldn't want to be doing that. However, You then put on a buy stop if you were doing that. And here it says buy that amount, which we've done, at 1.16. So that would be 1.16 in there. All right?
Yep.
And then the stop there is 1.1518. So that is the stop, where's it gone? 1518. And take profit. If all you're going to do is take profit at T1, which Jonathan did, I mean, he did it really without telling me. He came and I talked to him about the 23rd of December when I made 22 trades. 20 were winners, 2 were losses. Following the rules, never more than 0.9% risk.
Yeah.
Yeah, and following the rules. Anyway, he was so pleased with that, he put 250 quid in the bank into his trading account without me knowing. He said, I'm going to bed. And he went to bed, but what he did is he got the computer out and he started looking at possible trades. And he got 250 quid into his account, and it wasn't trading proper risk reward, which was really bad. However, he put the trades on, and then he went to bed, and he woke up in the morning with £340 in the account. I said, Jonathan, you're over trading. That's far too much money. You shouldn't be risking that much on each trade. Yeah, and he shouldn't. He should be doing it proper. So, but doing it proper, take profit. Then you could say, well, I'm going to take profit at 1.163.
You took the £70 off each month.
Yeah, exactly. That's right. So there you have it. So now it says take profit at T1 1.163. Okay. So does that make sense?
Yep.
Yeah.
Yeah.
So this platform doesn't allow you to put the stop losses in. We just see
No, there's the stop loss there.
There's the stop loss.
yeah, but
You
you've
put
got
in.
T1, T2, so you
What's
set T2.
No, you set another trade up, wouldn't you, for
So
the next
if you
amount?
wanted to do multiple tranches, now often what you can do is just target T1. Okay, the
Oh,
problem
you mean
is
you put 3 separate trades on, each with its own?
so here you've got that targeting T1, and that's it. You could just target T1, and if you just targeted that T1, you'd probably make around 0.75% if it hit it.
Yeah.
But the probabilities are quite high.
Mm.
So your probability is it will actually hit it and it will bank it.
Mm.
You know, and arguably, if you got 0.75% a day, you'd be very, very happy.
Just a bit. Yeah.
Because compounded, I don't know what it is, but compounded,
It's
that's
lots.
going to be in the order of 20% a month, and compounded, that's got to be in the order of, I don't know, 200 or 300% a year. You know, which is manic,
Yeah, yeah.
and that's all you're doing is you're only risking tiny amount of pot,
Yeah.
and you're going for a tiny amount of return. But if you just keep doing it,
Yeah. So compounding.
it's massive.
Yeah.
And going on to the multiple tranches thing, you can see here it says 0.86, right? 0.086. So those are like micros in terms of how many lots they are. So that's at 8 micros. But what you could do, instead of putting on 8 there, which is going for the whole lot on T1, you can then change that to say, I don't know, 3 perhaps. So you put 3 micros on to hit T1, and then you put another trade order on for 3 micros to hit T2,
Another one.
and another order on for 2 micros, and let the 2 micros run. Right, so T1 will then bank when it gets to T1, and that's that.
Ka-ching!
When you notice T1 bank, you move all your stops to break even. Whatever, all the stops now move to break even. So if it doesn't hit T2 and the other one doesn't run, all that does is come back and close out at break even, and that's that. So you've made one tranche at T1, and that's the end of it. But if it carries on, the second tranche hits T2, and it banks that. And then at that point, you can put a trailing stop on the final tranche. The stop of the final tranche is still at break even, but you put a trailer on it now. And the trailer is what you hear, the TR there, that's where the trailer should be, that number. So that tells you how much to put the trail on. And if you're a bit conservative about it, you want to take it off with any weakness, then you take it off when it comes down to 75% of that number. So you might put the trail on, in this case of 0.008 would be the trailer.
So how do you put that on then as a trading stock?
After the trade is on, which I can't show you now
Because it's not on.
because it's not on.
Go on and put it
But
on.
once you can't add the trailer onto here, sadly, straight away. But what you can do is when the trade's running, is you can then go and modify
Edit
that
it
trade
for a
and
trade.
add the trailer.
Yeah, yeah. All right, yeah.
So that's what I would do. And there you are, you've got a complete system.
Sounds good. All good stuff, John.
Yeah. There's a lot of wisdom invested in this tool.